Vikash Kumar Jain, strategist at CLSA, joins in. Vikash, always a pleasure to speak with you, and thank you for your time to NDTV Profit today. Great to have you on once again. What are you looking out for when you hear the speech from Finance Minister Nirmala Sitharaman on the 1st of Feb, and how imperative is it from a market's perspective, we're going through a tough time right now, that there isn't anything which can spook traders further?
Thanks for having me. So, interestingly, this budget, one key element has already been committed by the government when they gave out the last budget. I think the fact that they have already committed themselves at 4.5% fiscal deficit is an interesting thing about this budget. Now, typically, we've seen Prime Minister Modi-led government stick to such targets. What is important is what came out even in the July budget. If you remember, versus the February interim budget to the July budget, there was a bounty from RBI's significant dividend. That was nearly 0.5% of GDP, the incremental dividend. And the government chose nearly half of that as a reduction in fiscal deficit. What we must understand is effectively in FY24, we ended with 5.8% fiscal deficit. And we're expected to go in FY26 to 4.5%. That's a pretty big reduction in fiscal deficit. And in the interim, the reduction was also led by this big surprise bounty, the RBI dividend. Now, there are certain reasons why one can expect RBI profits to be strong this year as well. One of them is the dollars that they've sold towards the end of last year. But typically what we have seen is they have not accounted, the government has not really accounted for large dividends unless they are confirmed. So the few things that we are watching out for is firstly, is the dividend number coming down significantly? If that is coming down, effective revenue will be significantly down. Now, whatever is the revenue, and since we know the fiscal deficit, if they stick to the 4.5% fiscal deficit and they don't build in the potential surplus in dividend that might happen, then there will be a significant YY decline. Revenue minus fiscal deficit is the spending space that you're left with. So that is the first part that we look at, that how much is the spending space. But the more important thing is, particularly this third term of Prime Minister Modi, we've seen some noises coming which are a little different from the second term. Second term was out and out Capex focused. If you look at recent state elections, plus even the July budget, there was a clear outreach on improving the job situation as well as the consumption side. And even the handouts that we've seen in state elections. Now, this consumption part, does it continue to go to Capex like it used to in the second term? Or there is some new elements that will come on the consumption side and the job side, which might further shrink the Capex expenditure. So I think that's really what are the key things to watch out for. What we need to understand is, yes, there might be certain specific nitty-gritties. There's always a tobacco angle on taxes. There could be certain other indirect taxes which could be raised and cut and all of those things. Those are always there, but budget is more of a statement of intent from the government. A statement of intent from the government, which essentially, whether that intent is, there are three things to balance. There is the fiscal deficit promise, whether they keep it or not. And within the expenditure side, whether it is continued only Capex or there's some balancing done on the consumption and job side. I think those are really the things to watch out for.
No, so you've explained that really clearly and well, Vikas, but I just want to drill down on the point that you made on the difference that you see in term 3. In the context of the focus on Capex. Can you elaborate on that point?
No, so I think more than the focus on Capex, it's about trying to find the balance within the limited means that they have for expenditure. What I meant was, if you see, there are two other things which have now become important along with Capex, which was the singular focus in the period from 2019 to 24. Firstly, is a recognition that the underperformance in the national election was possibly some kind of feedback from voters that there are other sides of it, maybe whether it is the rural consumption side, whether it is the job side, which needs to be addressed, plus the realities of coalition politics, where you need to kind of focus on other areas as well, which might be politically sensitive. And the fact is that from 5.8%, government should have been happy to go to 5.1%. So whatever they got from the RBI bounty, they could have not reduced fiscal deficit further, but kept a large part of it on growth-related capex. They didn't do that. So discipline around fiscal deficit has become an important aspect. And thirdly, even capex expenditure, the actual expenditure on the ground, in the first 8 months that we have data for from the central government, that is till November, is down 12% YOY as compared to a budgeted number of 17% growth. Now, if you look at the last 4 years, YOY growth in capital expenditure commitment was anywhere between 25 to 40% versus that base. Here, you're not even able to meet 17%. Perhaps you'll be happy to end the year around 5%. That will also require a 35% increase in the remaining 4 months, which I'm not sure if it's happening or not. So that's a pretty big change in terms of capex numbers. See, this could also be the government simply saying that there was a COVID period where globally things were a bit relaxed. I need to tighten my seatbelts around the area of around the area of discipline, and that's why fiscal deficit has to be the focus. Secondly, a large part of the heavy lifting on capex has been done by the government. Now they might be saying that this is the time that private capex comes in. All of that is pretty much, I think that is the way it will play out. It's just that it may not play out in that way immediately, and there could be a gap between the time when the government capex's growth is reducing to the time when the private capex comes in. And stock markets typically aren't really that patient. And particularly when you see some of these capex related stocks, like we coined the term, Modi stocks, essentially to put together PSU stocks and capex stocks. These are the set of stocks which got super excited in the rally two elections. That is, from the December 23 period when the state election results came out till the national election results, these stocks went up by 54% or so. I think actual capex delivery hasn't been that unequivocal, and these stocks have started cooling off versus a 54% increase. They're down 13%. I think that trade of cooling off might very well continue if there is governments telling that we have other things to handle within our limited spending budget.
Yeah. So Vikash, good morning, Neeraj here. In the chance that the uptick or the capex number just gets reverted to normalcy, what was the budgeted monthly expenditure happens in Feb and March, let's say, right? The government penciled in the fiscal deficit number estimate with this 11% uptick in capex. If that is not happening, that's a significant amount of money not spent behind capex. You reckon that's rolled forward into the next year, or do you reckon that leads the government to actually overshoot the fiscal deficit target, or undershoot rather, in the sense they do much better than the promised number?
See, what we need to understand is that there are gaps in the revenue aspects as well, which have to be plugged in.
You think the revenue is lower?
So corporate tax collection has been lower. Disinvestment is going to be much lower than what they had budgeted for. And thirdly, subsidies, both oil, fertilizer, and food, will be higher. So there are these three aspects which are creating other areas where money, has to be kind of adjusted. And to adjust that, now how much does the government adjust down the capex? I have assumed in our numbers as 6% as the ending YOY growth in capex, but that will require a 35% growth in the remaining 4 months. If it is not 6% YOY growth, but even lower, then maybe fiscal deficit could be, instead of 4.9%, 4.8%. I think a lot of that is less important. It's the remaining 2 months that we are talking about. What is more relevant is what is the FY26 number looking like? Even with my assumptions, where I believe that I have already assumed, RBI dividends to be high, not as high as last year, but still not fall much. as much as what they used to be a few years ago. Even with those numbers, I'm not able to get to a capex overall number, a number which is I think 11 lakh 11,000 crore or something, which the government had budgeted for this year. I am not even able to get to that number in FY26, which means over a 2 year period, the growth will be less than 15%, which means the eventual growth might on an annual basis be a CAGR of, clearly single digit CAGR over a 2 year period versus a base of FY24.
Got it. Okay. So effectively, Vikas, what you are saying is that the government may choose to, of course, after funding all the deficits, choose to still stick to fiscal deficit and hope for the private sector capex to come by, as opposed to now bearing the mantle of being the capex doer, if you will. Okay. In which case, Vikash, where does growth come from, or do you think growth suffers? Because we've seen the first 2 quarters of growth suffer because of elections, erratic monsoons, what have you. The expectation was that Q3 will do well. It hasn't quite performed. At least the corporate results aren't that great. Do you think the economy hits a bit of a weak next couple of quarters as well? Because the opinion is split, right? Some people are saying that it's a multi-quarter slowdown. Some people are saying, no, we will bounce back as we have. What is your assessment?
See, I think the process of normalization can be a little longer than just a quarter's blip. That can always be the case if you have that kind of a blip in a quarter. See, a lot of what we are saying for a long-term watcher of India can be nitpicky. Okay. However, from a perspective of where expectations are in some of these stocks, it is relevant because that can lead to reasonable disappointment because of elevated expectations. I would say that we need to appreciate that a large part of the last 2 years, barring the 2Q, India was at a higher than potential or a potential average growth. So there could be a period where it kind of normalizes, and then we get back to whatever is likely a long-term average kind of growth, which is somewhere around 6.5% kind of a number, whereas we were growing significantly higher for a large part of last 2 years. A lot of that is, none of that is from a long-term India growth watcher a huge alarm bell. But for many of us in the stock markets, given at valuations that some of these growthy stocks are and capex linked stocks are, that could be disappointment. So, that's where I am kind of looking at things. In fact, if I were to look at our own CLSA's own EPS estimates and the key drivers that go into those estimates, things like credit growth, credit cost, commodity profitability, our analysts have assumed FY26 to be normalized kind of a growth year completely, which is, having 6.5% kind of effectively. If I were to kind of reverse math that number, they are in a way saying that it will be a normal growth year. But if that normal growth period takes a couple of more quarters, then earnings could also see more disappointments. We are already about 3% below consensus for FY26 and 27.
What are the opportunities you're spotting, if any, Vikash? Are valuations now beginning to look better? Are there any pockets where you think now the bearishness is overdone?
Sure. So I think, Tamanna, the thing is, I try and look at things from a perspective of lens of expectation in a very big way. And that is where I am quite, the thing that I mentioned about Modi stocks, that's where a lot of expectation was very high. Imagine 90% of those 50 or so stocks outperformed when they gave a return of 54% in the 6 months preceding election results. 85% of them have underperformed now, but the basket has gone down by only about 13% or so. I still see many of them at elevated valuations. So that's where expectation is very high. There needs to be a cool off for us to get a better entry point to play the multi-year capex story, which is still there. On the other hand, there are some areas like affordable consumption where expectation is pretty low. But if you were to look at some of these handouts which are there, that's pretty significant in terms of state elections, what has been promised. That, along with good rains that we have seen, should lead to some kind of a improvement in affordable consumption. A little bit of a positive blip over, improvement over there can lead to good performance for some stocks from those low expectations. So I am just trying to, in a year where we are anyways not expecting very
Affordable
large.
consumption, do you mean your staples FMCG basket?
That's right, staples primarily. So we went overweight staples at the start of this year, just about 3-4 weeks ago. That is in our India focus portfolio, that becomes the biggest overweight by a margin. That was a pretty out of consensus call. And I think that's where there could be some surprises. Barring that, I would also say that what this correction has bought us, there are many stocks which are down, significant 30%, 25, 30%. Some of them can start, we now have some bottom up opportunities to look at, to kind of consider. Those could even be rate sensitives, those could even be some discretionary plays. So those are the other areas where we also see, where we are still looking out. That's not really a sector that we still have in the portfolio. In our portfolio, we are overweight commodities and staples and small overweight on banks. But our big underweights are industrials, IT, and healthcare. So that's how we are positioned on the. But incrementally, we are very closely watching if we can see opportunities in rate sensitives, if we can see opportunities in some discretionary, consumer discretionary names. So those are the other areas that we are also closely watching.
Got it. Vikash, at a liberty to disclose the model portfolio, are you? Part one of my question is that. Part two, if not, is it more bent towards the large cap versus the broader end of the spectrum, or does the recent correction at the mid cap and the small cap and make some of those opportunities, which are large companies but not present in the top 100 simply because the top 100 only can accommodate the top 100 companies, are there better opportunities available at the broader end too?
Sure. So firstly, I think you guys generally have a pretty good access for some reason or the other of our reports. So you will have the model portfolio. I don't have to really kind of rattle the names on that. And I can't really be stock specific. So, but more importantly, the portfolio, the mandate in which we run the portfolio, it's a large and liquid India focused portfolio. We don't really have anything which trades less than $10-15 million ever in the portfolio. So basically, we are choosing from the top 100, 200 names, or you can say. So it's anyways designed to be a large cap portfolio. So, and more importantly, when we are talking about little less certainty on near-term growth, then that setup itself isn't a very helpful one for mid and small caps, which are extremely elevated on valuations. So, the setup for this year in terms of a little bit of worry on growth, and I would say a little bit of a worry on my biggest worry for India is a worry that Indian yields need to be higher than where they are. If I were to look at comparisons of where rupee depreciation expectations have gone and where US yields are. And that kind of a setup isn't really a very positive one for mid and small caps. And plus, to beat this, to outperform this year, I'm not really. I don't think my expectation is that if we can scrape this year with very low returns or and not very negative ones, that's not something that I'll complain about for the Nifty. If that is the case, then large caps should be able to outperform Nifty without much risk.
Managing expectations this year. Thank you so much, Vikash, for speaking with us. Always a pleasure, Vikash Jain of CLSA, reiterating that, and yes, we do get all the notes, but reiterating that staples in focus, and this is something that we've been hearing on and on again.
Yeah, certainly the defensive bent also coming into play.